When leverage starts to compound. Welcome to Steve's Income Property Playbook, where we break down how income property actually works. I'll walk you through the structure step by step, starting with an all-cash building, then a traditionally leveraged one, and finally the reset point where leverage begins compounding. This isn't about shortcuts, it's not about hype, it's about understanding how the math actually works. On this slide, I'm going to show you the structure, not the steps yet, and you'll see what happens when the same inflation-driven growth is applied to an all-cash building, a leveraged one, and then a compounded version over time. We'll walk through how this is built next and then come back to this slide at the end so it fully clicks. I've been involved in over 100 apartment house deals, and honestly, the wins were great, but the losses are what taught me how this game works. Along the way, I've worked through tenants in common structures, general partnerships, refinances, and 1031 exchanges. Those experiences taught me that real estate isn't about the deal type, it's about how you structure it to get the outcome you want. And now I'm sharing that same framework and the follow along growth stacks calculator I use myself, so you can evaluate deals with the perspective of someone who's been through multiple real estate cycles. This is basic leverage straight out of the playbook. When you control more property with the same capital, rent growth works on the entire asset, not just your cash. And that's why a small increase matters once leverage is in place. What you're looking at here is the Grow Stacks Follow Along Calculator, the same tool you can download and use yourself. And in this example, we're modeling an all-cash purchase at $450,000. You'll notice the yield comes out about 8.5%. And this is our baseline before our leverage changes everything. Now we change just one thing, the structure. Instead of paying all cash, we model the same $450,000 property with a 25% down payment. And notice what happens to the yield. It jumps to roughly 17%. Same property, same income, but with 4-to-1 leverage applied. This is where leverage starts to compound. A $200 monthly building rent increase doesn't just improve cash flow, it resets value in what the bank will lend. And once income rises, borrowing capacity refreshes, and the cycle can begin again. Here's the part most people miss. A $200 rent increase just created about $20,000 of new borrowing capacity. Nothing magical happened. Income went up, the bank reran the math, and increased the loan capacity. That $20,000 is now your decision point. You can pull it out and spend it, or you can put it back to work. What matters is understanding that you didn't save this money. The property created it for you. Instead of pulling the $20,000 out, let's put it back to work. $20,000 reinvested at 8% yields about $140 a month, and your rent increase produced $200 a month. So you make a $140 loan payment and still have $60 per month in excess cash flow. And that's the key. Leverage works best when the new income carries the new debt. This is negative leverage, when borrowed money earns less than it costs. And here, the loan requires a $140 monthly payment, but the reinvestment at 6% only produces $105 a month. That leaves a $35 monthly gap. Now you can cover that gap for a while with your existing cash flow, but that's how people get caught. If income doesn't grow, negative leverage compounds in the wrong direction. This is compound leverage in the real world. With the same building and the same loan, steady 4% rent growth over a 6-year period creates about $290,000 of equity and new borrowing capacity. And that becomes the bridge from 4-to-1 leverage to 8-to-1 leverage over time. But this is where discipline really matters. We don't force the next step, we wait for the math to make sense again. And that can happen as rents rise and income grows, as financing terms improve, or as prices adjust and yields normalize. When those pieces realign, leverage becomes viable again. And now let's look at what this cycle actually looks like in a real example. The first building starts with standard 4-to-1 leverage, and as income grows, we refinance the first building, increasing the loan against it. That refinance converts equity into cash, which becomes the down payment on a second 4-to-1 deal. The key is that the higher loan is supported by higher income and not speculation. Now notice what actually changes when we use compound leverage. The growth rate doesn't change. Inflation is still about 4%, but what changes is the amount of real estate that's growing. More property at the same rate means more dollars compounding every year. The bank isn't betting on appreciation, it's lending against income and collateral. As rents rise, values rise, and the bank is still secured by the building itself. And that's why apartments can be releveraged responsibly, while most other assets cannot. This is how real estate wealth actually grows, not through one big move, but by repeating a disciplined structure over time. Income funds the next step, leverage stays controlled, and the asset base keeps expanding at the same steady rate. That's compounding leverage, and in the next lesson, we'll keep building on it. The follow along calculator gives you the power and the confidence to run your own assumptions and see the outcomes for yourself. When you understand the numbers, you walk into a deal knowing more than the listing agent or the realtor, relying on old rules of thumb. And this is how you learn to structure deals so the formulas will actually work for you.